Who is trapped in the market? That's what we're going to try answering today. Good morning, ladies and gentlemen. So if you guys have been feeling trapped in this market, not necessarily knowing what's going on, well, I do have a solution for you. We're going to go over key levels in this video for you to pay attention, to know where the market's going to be rotating to. And as always, you'll have our debate at the end of the video. The key levels, we'll talk about VIX, dollar yields, and the biggest winners and losers. So everything will be timestamped down below for you. So feel free to skip to any section of the video. So going over the market real quick recap here. Pretty nonchalant week. We closed up on a higher week above the previous week's close. So now we're starting that bullish rotation. I will talk about more on that in the key level section of the video, where we're going to go over how those levels are established to know when it's going to counter rotate, and basically set up simple patterns that you can play out for yourself, understanding these levels to make money in the market. It's not actually super difficult, guys, but you just have to make it as simple as possible and also have a proper management strategy to that. So S&P kind of pushing up during the week, still maintaining that trend. However, we did have a dip earlier in the week with that CPI print and the bank earnings kind of being lackluster that we did go over in the live stream last night. So if you guys missed that, it'll be down in the description below so you can rewatch it, all time-stamped in that video as well. So you can skip to any of the banks we covered: JP Morgan, Bank of America, Citi, Wells Fargo, and United Health as well. We throw that one in at the beginning of the video just because Fatal wanted to cover that one, and I've been trading it for a while, so you know, kind of best of both worlds. But before I digress, NASDAQ having a similar story as well for this area, similar to market dip, push back up. So again, kind of seeing that pattern rolling out, that once we start seeing that rotation on those better numbers, we started pushing up again. Russell, not as healthy as the other markets. So we're starting to get some divergence in the markets. That'll be an interesting thing we'll go over of what it actually means and how you can profit off of it. So first off, let's go take a look at the news real quick, what happened this week, so we can understand the basis for what catalyzed this week. So first of all, we had Bostic speaking, which was one of the Fed members, kind of giving more bullish tonations during the week. We had Barr speaking, but really didn't give any policy marks there. Crude oil inventories coming in above expectations, so that's bearish for crude, bullish for if you want to pay lower gas prices. But Williams spoke as well, and he really kind of walked the middle, similar to Powell. We kind of been talking about on the channel that Powell and Williams both speak very down the middle. They don't really side to one side or another, but we did have a couple Fed members Thursday and Friday, we'll go into just a second, kind of giving mixed tonations. Goolsbee coming out basically saying, hey, we're happy with the data that's coming out. This latest data point of PPI doesn't necessarily mean anything. It doesn't buck the trend. And then we had one other Fed member, I believe it was Barkin, that came out and basically, yes, Barkin here on Thursday, after seeing the CPI report, ticking up 3.4 on regular CPI, so a nearly 0.3 increase year over year. However, month increased 0.2 on the volatile CPI. Heads up, guys, the Fed really don't care about CPI. So core is what the Fed is actually looking at. And if you look at that, 4.0 to 3.9, previously 3.8. So stagnation of progress, that's not necessarily good. In combination with the CPI report coming out year over year higher, it's starting to send alarm bells off in everyone's minds. However, we are going to discuss what this means for the rate hikes in the later part of the videos. So make sure you guys are subscribed to the channel so you don't miss any of our videos, as we do this week in deep dive video every single week. So if you guys find value in it, throw a like on the video and a comment. We really want you guys to comment what you think of these videos, how we can improve them. If you want it to be shorter, you want it to be longer, throw it down in the comment section below. We really want to hear your thoughts. So initial jobless claims ticking down again. So we're seeing that bullishness in the jobs market, not necessarily good or bad for inflation. And as always, on Friday, we got our net speculative positions actually cutting some of their positions on the S&P. Previously was 214K, now 117K, so almost a half or 100K position decrease, whereas the NASDAQ actually still staying strong in the bullishness. So a lot of people piling into tech, kind of being the Magnificent Seven. Everyone's being in those, not necessarily the broader market. And we'll talk about RSP in the key level section of the video. PPI coming in better than expected, lower. So it kind of bucked some of that CPI trend. But again, it could be a very choppy area for PPI, CPI, and then PCE as a whole. So guys, Fatal will now give you guys the biggest winners and losers, and I will be back for the key level section of the video.
So this was the week of earnings when it came to the banks, and well, we could see that markets actually did do pretty good, at least on the 5-day for the S&P, up 1.58%. On the 1-day, 0.08%, kind of flat, nothing really happened. When it came to the banks, they did report as of Friday, which is this 1 day ago, and man, they did report very, very poorly. Very, very poorly. Looking at this past week's earnings, we can see here that on Monday, we didn't have much of anything. Helen of Troy, I guess. On Tuesday, we got Tilray, which I did cover, and for example, WD-40. On Wednesday, we only had two companies, KB Home and Richard Electronics. On Thursday, Infosys, NTI, and Concrete Pumping and Holdings. And on Friday, this was the big one. We got companies JP Morgan, United Health, Delta, Bank of America, Wells Fargo, BlackRock, Citi. Whew, so many companies here that it was just completely massive day, stockpiled on Friday, and the banks actually did not do too good. All of them missed on revenue by several $billion, all except for Wells Fargo, which barely did a little bit better at a positive $100 million. If we take a look at next upcoming earnings for January 15th, on Monday there isn't anything. It is Martin Luther King Day, markets are closed. Tuesday, we got companies like Goldman Sachs, Morgan Stanley, PNC, Applied Blockchain, and Interactive Brokers. On Wednesday, we got Charles Schwab, Alcoa, Discover, Prologis. On Thursday, we got companies like PPG, Truist, JB Hunt, and First National Bank. And on Friday, we got SLB, Fifth Third Bank, and Ally, Travelers, and State Street. Looking at now the S&P 500 heat map, you guys can see that this was mainly buoyed up by the tech sector, the main two companies in the communications, and Amazon. That's literally it. So let's take a look at now the technology sector, guys. We got over here the worst performer being none other than the company HPE, Hewlett Packard Enterprise Company, losing 7.46%, and the best performer being the company Palo Alto Networks, gaining a whopping 15%. Looking at the communications sector, worst performer here was none other than the company Paramount, losing a whopping 9.01%. And the best performer was, of course, Meta, gaining 6.4%. The consumer defensives is rather flat, as y'all can see over here. Worst performer, by the looks of it, would be none other than the company Bungie Global, losing 3.19%. And the best performer, it is none other than the company Constellation Brands, gaining 4.35%. The healthcare sector is kind of 50-50, massive gains but also massive losses. Overall, though, worst performer was the company Walgreens Boots Alliance. This thing is still continuing to fall, losing 6.96%. And the best performer, it is none other than the company Intuitive Surgical Inc., gaining 12.78%. Looking at the financials, obviously this one was under a microscope, seeing that we had the big banks, and by the way, all of them fell, having earnings this week. So worst performer here was the company Regions Financials Corp, losing 5.72%, and the best performer, it is the company Brown & Brown, gaining 7.01%. Consumer cyclicals is mainly just one big green dot and one big red dot, and yeah, I don't think no other one surpasses those losses when it comes to Tesla, if I'm not mistaken. Worst performer here, it is none other than, of course, Tesla, losing 7.83%, and the best performer, it is none other than Amazon, gaining 6.46%. The industrials, as you guys could see, it is very flat, all except for one company which lost a lot, and then one green one that did decently. Overall, though, worst performer, it is, of course, Boeing, losing 12.57%, and the best performer, it is the company Jacob Solutions, gaining 5.73%. The real estate sector, honestly, kind of 50-50. You guys could see, worst performer, it is none other than the company EXR, losing 3.64%, and the best performer, it is the company Health Peak Properties, gaining 6.16%. The utility sectors, you guys can see, it is a bloodbath one more time. Only 3 of them gained. Worst performer here, it is the company Eversource Energy, losing 8.36%, and the best performer, it is First Energy, gaining 0.63%. Of course, the only 2 other ones that gained were EVRG, gaining 0.28%, and AWK, gaining 0.24%. Following the utilities, the energy sector also fell massively. Worst performer here, it is the company Devon Energy, losing 6.9%, and the best performer, well, actually there's only 2 gainers here, and that would be Valero, gaining 1.94%, and Marathon Petroleum gaining 3.25%. And when it comes over here into the basic materials, worst performer, it is Mosaic Company losing 7.71%, and the best performer, Sherwin-Williams, gaining 2%. So very, very interesting when it comes to the S&P 500 this week, guys. You guys can see it is mainly being buoyed up by the tech sector. That's really it. Very interesting. We'll see what happens when tech has their earnings. But anyways, that pretty much does it, guys, for this video. Make sure to like, subscribe, comment. Really does help here with the algorithm on YouTube as well as Rumble. Make sure to follow us on X. And with that said, take it away, Mike.
So guys, we're going to start off like we always do with the weekly chart. Why do we use the weekly chart? The weekly chart kind of gives you a larger time frame. So if you're looking at the weeks as a single candle, you can pretty much determine how the day is going to go, how the weeks are going to go as the larger trend extrapolates out. So looking at this, if we just snap a horizontal line to the upper wick of the candle, that's going to be our resistance, and then support is going to be at the lower end of the candle. We're actually going to make these lines slightly smaller just so we can see them a little bit better. But looking at that, we're basically closing near the high of the previous week. However, we did not actually close above the 2-3 week look back candle. So the way I look at this, guys, is where this previous high that we pierced of, I always put a white line to it because that's telling me we're really getting that bullish rotation in the market. And another point that I'm really going to be curious is that $473.67 point. Well, why is this two things important? Well, number one, why is this important? This is our 2-week look back on the upper trend, the top of that trend. So if we're going to see a continuation of that trend, we're going to want to see rotation above there. We struggled for 2 candles, as you can see, denoted by these 2 candles, Thursday and Friday, to actually close above that level. We opened at that level on Thursday, failed to close it, went all the way down to 472, defended 472, came back up for a nice hammer style, inverted hammer style candle. So bullish candle there, however, still in decision, because we closed in the range of the previous candle. Then on the preceding day, on Friday, we had a doji style candle and open higher but closed lower. So all these things are telling me that we're meeting significant resistance, and our all-time high is 479.98. So we have to see how that all plays out as a conjunction. We're hitting that really hard resistance at this point, and we're failing to break above it on multiple days. So now the question is, are we going to start rotating lower? Are the bulls trapped or the bears trapped? You know, it's always a question of who's trapped in what way, shape, or form. Seeing the net speculative positions go down, I'm going to say that there is a higher probability that the bulls are trapped versus the bears. Now, I'm not going to say that with 100% certainty until I see the chart break. How do we know the chart's going to start breaking? Well, 473, 472 area is where I want to see a close below. If we close below both those levels, then I'm basically going to say, okay, we're definitely going to start seeing bearish rotation to 468.30 at a minimum. So there's a nice short position that you can make money on the downside. Now, let's say you're not someone that necessarily likes the downside. Okay, 468.30 is your support. You bounce off 468.30 or close back above it, rotate back bullish, buy the chart and ride it all the way up and see how it approaches those 473, 472, and then 477.50 level. So that's all you really have to do. You just have to pay attention to those areas and basically say, okay, am I rotating bullish? Am I rotating bearish? What levels do I have to pay attention to? They're all on the chart here for you guys. So you can make sure you can pause the video, see them nice and big on the right-hand side over here, and I will call them out for you. 468.30 being the lowest support area, 472, 473, 67. Hey, we're starting to get bearish rotation, and then bullish rotation 477.55 with confirmation breaking at about 478.60. So once you break 478.60, probably the sky's the limit. Probably see a blue sky break on S&P, and we'll join the rest of the indexes in their bullish runs. Next, NASDAQ, one of the more bullish indexes out there. Well, I take that back. It has been bullish, but right now we're questioning that bullishness. We failed to close above the 2-week look back candle, similar to the S&P. So we have our levels that we have to pay attention to for the week. So as we can see here, our resistance is going to be 411.12, and then 412.92 is all-time highs. So we have to pay attention to those two levels. We also have a 497.84 being the level below that we need is going to be our support, which is the previous basically start of the week. So we started off, pushed up higher, and then met resistance. So there's more opportunity to the downside, but we need to see how we're rotating. So if we go back to the weekly view, we only really have one rotation point here, which is the previous week's high. So if we're below the previous week's high, that's going to tell me, hey, there's maybe a more bearish rotation heading there. And 406.09 is the previous week's high on QQQ, or the NASDAQ as I call it. And then 397.84 is where that's where you need to find support. If you don't find support, we're heading a lot lower, and then we could significantly retrace. You really got to look at basically trimming positions and saying, okay, putting in stops, raising stops, and basically saying, okay, I need to either be bearish skewed the market, trading it bearish, or I need to basically step away from the market for the time being until we find reasonable support. Now, if we get back above 397.83 for later, hey, then re-enter the position and keep going. So there's no risk there necessarily of being outside the market for a short period of time for it to find some semblance of sanity, some semblance of direction. 411.25, you start breaking that on a closing basis. 412.92 is probably going to get blown out completely, and we could definitely be heading to the 418s, 416s level very, very easily, having a nice rotation to the upside, creating a nice bullish market. Now, I talked about how we can identify if we're going to see more bearish or more bullish skew, and I really look at the RSP and IWM. IWM is the Russell. The Russell is 2,000 companies, so when we saw the Russell running, we saw the broader market running as well. And as you can see here, we are below all our levels that we basically come to. So we're going to clean up the chart a little bit here, and we're going to go to the weekly view here. So the week, pretty much a crapshoot. We closed below the previous week's close. So the close of the previous week, 193.25. We closed 193.23. So 2 cents, but it's a lower close. However, we did not close below the previous week's lows, so there is some semblance that this may be a rotation back to the upside. However, it is going to be a struggle getting back up there. So we have to basically look at skewing the Russell bearish. I had an open position on this Iron Condor. I was expecting because Russell had massive implied volatility, and it didn't work necessarily out. I lost $2 on it. I could have made more money, but again, I managed the position. I basically said, hey, I'm cutting my losses because this is not what I'm looking for. We're establishing a strong trend with low volatility and volumes going downside. So 3 red flags. You look bearish on Lux Alga here. That will also be linked down in the description below if you guys want to look up that program. I use the program. I am a lifetime subscriber to it, so you can get it for a yearly membership. I like using it. However, you can also try it out for a shorter period of time, see how it likes, if you improve or not. It all depends on what your trading style, what your goals are, and everything. But before I digress, Russell's sitting near the lows. Consolidation here. So whichever move I think we see on the Russell first, I do believe that it's going to continue into the broader market. I do believe Russell is going down lower because it, one, filled the gap that it had previously here and kind of stayed in that gap. So if we start breaking up or down, I'm not going to really indicate which way we're most likely to go. I'm looking more downside when you see divergences in the market. However, if you basically don't, well, if you break above 197.10, guess what? Play bullish. Like, it's not that hard, guys. If you start breaking these levels to the upside, it's probably going to continue with momentum. You break back below the level, you just close the position, have your stop loss there, and basically you just keep your money and you don't do anything with it. So there's multiple ways. You don't always have to trade the market. I always talk about this, guys. You don't have to trade every single day. You don't have to be in a position all the time. You can sit on your hands and wait for the market to give you a clear direction. Trading's supposed to be simple. It's not supposed to be hard. We overcomplicate things, and that's how we lose money, because it's like, okay, question. If the chart's going up and you're betting bullish, what is the probability of you winning? If the chart's going in every single direction and you're betting bullish and bearish, you're pretty much going to lose all your money. So just wait for it to be completely simple. And RSP, this is where it gets really interesting. We're just sideways. We're completely sideways on RSP here in this very long range contraction or expansion. And basically we're making lower and lower contractions. So therefore that once this thing breaks, it's probably going to break pretty monumentous to the upside or downside, kind of smacking into different zones, different areas of price action. So we have to see, do we break 157.38 first, or do we break 155.16? being that you're below the bearish trend right now, I'm leaning to breaking 155.16 and probably the S&P going lower. However, I'll be looking at this and the Russell for early indications. Now, if you guys really want to see some crazy early indications, then we have to go to VIX, a dollar, and yield. So looking at DXY, which is the dollar index, as you can see here, the dollar has been falling for several straight weeks, consolidating in this area. However, most likely sending up a previous pattern here where we went down, consolidated, went down, consolidated. Well, you tell me where we're going. So that's going to be important for us. Keep attention to, does the dollar break 102? Dollar breaks 102, market probably being bullish because it's counterintuitive to one another. Next, VIX. VIX has been, well, let's say very stubbornly sitting around this $12.50 area. Not really seeing a lot of volatility. However, we really see these like bearish trends kind of established for a short period of time, then a pop, and then bearish trend, pop. So VIX hasn't really done anything. Is this the calm before the storm? Is this basically the thunder before the storm rolls in? Whatever analogy you want to throw out there, feel free, throw it down in the comment section below what your favorite analogy is. So looking at this, VIX hasn't really broken down, so we're not really seeing a degradation in the market. Again, I don't expect VIX to break down because I have to keep option premium relatively same because a lot of people trade those 0DT options, so you definitely want to keep some intrinsic value there for all those option traders because otherwise you're going to not have an options market. So again, looking at this, VIX could pop off easily to 14, create some more volatility. Could have that pullback in the market. I'm not expecting a huge pop this week in volatility, but you don't know what you're going to get until you get it. So keep an eye on VIX. Basically, once it starts breaking above that $13 point, then we can say, okay, well, maybe I shouldn't be putting on as much risk as I originally was going to put on. And now if VIX pops to 14, kind of calms down, is coming down, then you can layer on that risk as you go. It's basically a good indicator of when you should be risk on versus risk off. And last but not least, the famous yield curve. So the yield curve is basically going significantly down, sharp decline in it. We're trying to uninvert, and when this thing uninverts, guys, we covered this in the live stream, Armageddon basically breaks loose. So we saw this before where we had a sharp decrease and then basically stopped. Sharp decrease, where is it going to stop, or is it not going to stop? So we'll keep you guys updated on this on Twitter. Make sure you guys follow us on Twitter, Fatal Investing at twitter.com. So basically check us out there. We post the reverse repo and we post the inverted yield curve, various other statistical facts that you guys can follow. Make sure you follow us on there so you are up to date on all of that. And speaking of the reverse repo, we actually had a new low in the reverse repo. So we previously had the low of 683, now 603 billion dollars. So we just keep making lower lows on this. So liquidity is slowly draining out of the bond market. And last but not least, let's just go over the bonds. 30-year, 20 and 10, all looking similar, with now decreasing after they hit the 200. So everyone's basically going back to that euphoric expectation that the Fed is going to cut in March. And we did have one Fed member kind of walk back that March may not be appropriate for cuts, especially with the latest CPI report. Now, they're going to see two more reports prior. They'll see PCE. They're going to see two more job numbers. So they got to have a lot of data before they make their March decision. January, they're expecting to basically hold rates steady. So we have to see if Powell says anything obtuse that scares the market, or does he kind of just mellow down and kind of follow that melody as we go. Obviously, yields would fall lower, bond prices would go up. So like your TLTs actually struggling to hold that 200, could come down to the 50. So could see a pop in bond yields, bond value going down. But this still indicates that banks, even though we're on this massive uptrend from 82 to 96, we're still heavily underwater for the banks. Just to put into perspective, from the peak of the monetary policy easing to the bottom of the tightening was a loss of 51%. Now you're at 43%. That's still a catastrophic loss on bond assets. So therefore, banks still underwater, kind of indicating by JP Morgan's, Bank of America's, Wells Fargo's, and Citi's earnings. They weren't necessarily like super ecstatic about their futures. Like, you know, they sugarcoated as much as they could. However, it wasn't one of those like stellar earnings that everything's hunky-dory that we saw in Q3, Q2 of last year. And last but not least, guys, we're going to go into what the news for next week. What are we going to have next week, Mike? Well, a whole lot of nothing. Monday, holiday, markets close. Empire State on Tuesday. Only thing that would kind of excite me, retail sales on Wednesday, but it's really not going to necessarily move the market. Atlanta Fed GDP now coming out Wednesday. Not really market mover. Fed, we got different manufacturing indexes coming out on Thursday. Home starts, initial jobless claims as always, and then crude inventory on Thursday. So nothing really super exciting. We have existing home sales, so nothing like super strong catalyzing for the week. So the market is just going to be left to its own devices, but we do have some other stuff that we have to talk about, which is a Netflix earnings that are coming out on Tuesday 23rd post-market. We got Tesla on Wednesday the 24th, and I believe that is it. Let's see, with Microsoft this week, Microsoft is Wednesday the 31st. So not this week, the following week. So got Tesla, got Netflix on a deck. Do we have Google by any chance this week? Nope. Thursday, February 1st. So no big players besides Netflix and Tesla earnings this week. So looking at this, Tesla bearish right now below the moving averages, so probably looking at shorting opportunity there. Netflix having a pretty massive run, but struggling in this area. So we have to see how that plays out. That could be an interesting volatility play on earnings. Their IV is pretty high. So I will talk about in the theta video probably that Netflix opportunity play. So make sure you guys are subscribed and have the bell notification on so you guys can remember to check that video out when it comes out and are notified of it. So with that, guys, we're going to dive into the debate section of the video. If you want to minimize the video and just have us as a talking head, thank you so much for watching so far, and make sure you throw a comment down below to tell us what you want to improve with the video, what we want to tailor it to you. And again, thank you so much for watching. So now let's get into the debate section of the video. So I think we'll start off with what earnings are you excited for this week? For me, it's going to be Netflix and Tesla, but I'm curious what yours are.
That's actually a great question. Tesla isn't this week, my dude. Let's just start off with that. This week it is mainly Goldman Sachs, Morgan Stanley, PNC, Alcoa, Charles Schwab. Yeah, Tesla's not this week.
I thought it was this week. My bad.
No, it's not. Yeah, it's not. I'm mostly interested for, I guess, just Goldman Sachs and Morgan Stanley and PNC. Honestly, PNC may be a good one because PNC is one of those banks that looks interesting, right? But they don't tend to hold back when it comes to telling people like what they think. So yeah,
they had a pretty good run into earnings. So as you can see here, nice run into earnings, kind of pushing back towards this gap. So could be an interesting one, especially since the banks didn't give us very rosy pictures like in comparison to 2 quarters ago.
True.
And you're saying the PNC banks is basically like, you know, now I want to say like red-pilled version of JP Morgan, but it's almost like the red-pilled version of JP Morgan where they're just like, here, we're all going to die. It's horrible, or it's all rosy and beautiful. We're going to make millions. So it's going to be really interesting.
Well, I'll tell you why. It's because they're regional. That's why. They're in the regional banks. That's why. So yeah. That's why them and Ally might be a good one. Ally is a weird one because majority of their the majority of how they make their money is through auto loans. So Ally on Friday might be a good indicator as to how the auto market, the car market's actually doing.
Well, speaking of the car market, just not digressing too much, I was looking into how many recalls have vehicles been taken off the market. It's close to 1 million new vehicles have been taken off the market in the last month or so due to all these massive recalls by Ford, Honda, like Honda having engine problems. I'm like, well, there's the reliability title going out the window. Ford Lightning issues, Toyota CVT issues. I'm like, is every manufacturer just basically just burying themselves in problems? And this
makes you wonder what caused it.
Well, mainly the poor manufacturing processes back in 2020 when a certain thing came around that we can't mention on YouTube.
We can mention it when COVID came around 2020. Yeah. And then we had a massive chip shortage too.
Chip shortage, worker shortage, quality of worker shortage, like all these things combined. It's like now we're seeing the repercussions of it. So it's similar to 08, 09, where they did cash for clunkers. They never recovered those low prices after cash for clunkers. So we could see a very quick meme reversion, even though like the auto loan and auto sector has been going down. It could have a meme reversion going back up again as the scarcity of vehicles, and now you're taking that supply out. And are we going to now see that maybe 2-3 reports down the road in the CPI? Because remember, auto sales were one of the driving factors in these larger pushes in the report. So it's really taking a Russian roulette almost of which bullet is the chamber going to land, or what the bullet is going to land in what chamber to figure out which is going to be the one that's going to prick you on the CPI report. Because
so about that, about that, when it comes to the CPI report, there really wasn't much change when it comes to the new cars and used cars. I believe new cars only went up like 1.6%, and then used cars fell like around 1.3. So at least this is as of the last CPI, right, for December. But no, I get what you mean, and this may impact more new cars, which, if new cars prices go up, I personally don't care, because new cars should be worth more than old cars. That's just,
but what we've
here.
seen is as new cars prices, like you had the domino effect, right? So you can't get new cars, so new car prices go up. Therefore, used car prices go up. And then it's like the self-fulfilling loop of as new car prices go up, it causes the used market to go, so the scarcity in the used market goes up, so therefore the new cars. So it's this never-ending loop. So it's going to take months. It's going to take months. You're not going to see it in the next 2 CPI reports. I don't even think you'll see it in the third. I think you'll have to see it all the way in June.
But is a million cars enough to make a dent? Because for all you know, a million may not even be that much if they fix it and then
history. Cash for clunkers took nearly 500,000 cars off the used car market, and the prices never went back down to that level ever again, like ever in history. So a million, and with again going back to shortages, right? The shortages, these car companies don't have millions of cars just like ready to ship. Like we see these videos and these images of the graveyards of Ford trucks, Corvettes sitting out in the GM plant, thousands of them, hundreds of Kias, to like all these companies, they have like these mass graveyards of cars waiting for parts. So now you have that supply chain issues that still exist, and on top of it, now you're telling them you got to take back 250,000 cars. Like 250,000 cars is a lot.
Okay.
So
I guess
I
we'll
think
see.
it's going to go bad.
I guess we'll see, though. For me, that's not really trending too well. If you are correct, because I am trying to buy a used car.
Well, you got 3 months. You got 3 months before it hits, probably.
No. Okay. Yeah, sure. We'll see how that goes. But aside from that, what else do we got over here? The reverse repo. That is quite interesting.
Well, I did cover the reverse repo going lower. New low.
Yeah, but I haven't. Wow, look at that.
But it's 306. Sorry, 603. Geez, I'm dyslexic today. So looking at it, the trend's intact. Simple as that. Like we bucked the trend right here when it went to like 1 trillion increase from all the way from like 683. Like when Powell opened his mouth, that's what happened, to instantly be reversed the next subsequent days. So it's very interesting with that, how that all played out. But there's nothing much this week. They're still expecting rate cuts like crazy, going to like, look at the percentage on March. Ease 81%.
Yeah, that's crazy.
I'm just crazy. Now if they were saying like June, July, I'm like, okay, I can see, like, there's a possibility there, as much as I disagree with them, but I could maybe get enough rationale that I would maybe agree with them. I think March, especially with the latest report, is too early.
So go back to the reverse repo.
Sure.
For all those of you who may not know, what's going to happen, or what can happen if this thing hits zero?
So this is how the bond market gets liquidity. When you have tightening, you draw liquidity out of said bond market. This is the Fed's basically lever that they can use to push liquidity out into the bond market. Well, why is liquidity important in the bond market? Well, think of it like this. If you don't have oil in your engine, how long do you think that engine is going to run? About 3 miles before it implodes. So if you don't have liquidity in what funds every financial institution, the world's financial market implodes. And, well, you can come up with all the different consequences in your head and just make it like 20 times worse. That's probably what would accurately reflect what would happen. So AKA, they won't let that happen. They'll be forced to go back to quantitative easing, to cutting rates, to creating probably the worst inflation we ever seen in our lifetimes. And it's going to be very interesting, but I do think you get the instantaneous deflationary crash to then have the instant inflationary jump back up. That's my theory on it. We've never seen in our history, in living memory, what happens when the bond market basically like seizes up. So it's going to be very interesting. Now, once the reverse repo drains, you will have the Treasury, which has the Treasury General account, probably can keep the bond market afloat for at least a month or two. However, the cat's out of the bag at that point. Because the Treasury, if everyone starts seeing the Treasury General account go down, they're all going to be like, why is the Treasury General account going down? And then Janet Yellen is going to basically start, yelling at the top of her head of we need easy money. So at that point, cat's out of the bag. It's going to be a really fun time. And at that point, I think 10% yield, Jamie Dimon said, or some famous person said 10% yield on a 2-year bond. So I'm like, yeah, I could definitely see that.
That is terrifying. All right, cool. Because I know a lot of people are asking, like, what does this actually mean if it does go to zero? So, yeah, just wanted clarification on that one. But, yeah, aside from that, there really isn't much of anything happening right now. We just have to wait and see what happens next, or like mainly at the end of the month when it comes to the FOMC. But when it comes to markets, how did it do this week?
So
when it comes to the fear and greed.
Fear and greed, 71. We actually, if we look at the timeline here, we kind of just went absolutely like nowhere. Like we ticked up, ticked down. If we look at it as a whole, it's like, like that's how I would describe it. It's not really doing much.
Got you. It's just not really doing anything.
Yep. So it's pretty much going to be, the market's going to be left to its own devices this week. So it's really going to be interesting to see what happens when you get a non-catalyzed week. There's literally nothing in the news that's going to be a catalyst. You got a couple
from earnings.
But even that, you don't got any of like the Apples, the Microsoft, the Teslas, the Netflix. You don't have those to be the, like, no one cares about Goldman Sachs, Morgan Stanley. Comparison to JP Morgan.
Okay. In comparison, yeah, I was about to say, I'm like, well, it sounds
no,
like
they care, but it's not like not every single person's eyeballs are glued to the market when JP Morgan reports.
I'm very curious to see what they actually show because we did the live stream yesterday, and out of the 4 banks, 3 of them had negative $1 billion+ in losses in revenue.
Yep.
Well, not losses, but I guess misses. Sorry, not losses, but misses when it comes to analyst estimates. So.
And again, are they setting the bar? It's going to be interesting to see Netflix and Tesla and Apple and Microsoft, Google, because if we're seeing the bar being set so high with them, the banks, and usually people don't have high expectation for banks, right? Like that's not the standard practice. The standard practice is you go crazy for Netflix, you go crazy for Amazon, you go crazy. If the bar is this and they're missing, I don't want to even imagine what the bar is for those companies when they miss.
Yeah, especially like Nvidia's and that kind of stuff. Companies that have over 200 PE. It'll be very, very interesting.
Well, look what happened to Apple. The second Apple had whisper of possible sales issues, and another bank reiterating it.
Nike.
The meme stock.
Nike took down the entire. Bro, Nike took down the entire shoe industry.
Wow.
I'm like, I'm over here looking at Crocs. I'm just like, why is Crocs falling 10%? I'm just like, what news came out? I can't find anything. And I'm just like, wait a minute. Wait a minute. What does it say right there? Nike. What about Nike? I go to Nike and I'm just like, Nike says sales may be in danger for Q4. I'm just like, but that's Nike. That's not Crocs. What's happening here?
That is funny how like Crocs issued, because it wasn't even their earnings. Like they came out and they basically just issued like better fourth quarter guidance, and I'm just like, wait. So jump into Crocs real quick here. So this wasn't an earnings day. Their earnings is in February 15th.
February.
So you pumped. This is how funny it is. You pumped 21% off of a company telling you stop being a moron and stop listening to everyone else. But literally, it's astonishing how now it's fighting that 200 on Crocs, so it could come down back to 95 a little bit, 97. But before I digress, we've talked about Crocs on the channel. It's a very strong fundamental company. Their earnings are pretty stellar. So that how it's being treated by the market.
Not their earnings, their fundamentals.
Cash flow, yeah. But their earnings have been good. Like they provided, and they're being transparent. They're like, look, this is the worst case scenario, but everyone's taking the worst case scenario as reality. And I'm like, you guys don't do this with anybody else. So I'm like, okay, thank you for letting me buy them at cheap. And looking at it, it's like every time they got a dip, like the latest dip, it's like buy more. It's like what. They're literally, you're giving the worst case scenario, then they come out several weeks later being like, oh yeah, we're increasing our guidance, we're reaffirming and increasing prior to earnings.
So not financial advice, obviously. I know you said buy more, but not financial advice, guys. Not saying to buy Crocs at the price that we say. I mean, I bought the thing at 116. It's been a rough ride, but funny thing you said that, because could you imagine if Crocs pulls an Nvidia?
Well, see,
you know what I mean by that?
Yes, but the thing, and it can, like this company has, like when it starts moving because of the low volume, it can basically blow out and short squeeze a lot of people. But the problem with that statement is it actually has good fundamentals and it's actually worth the price that it would be at that point. So it's not like Nvidia that's going to have a 200 PE and trading like 2 times its evaluation. Crocs is like trading 1/4 of its evaluation and then would go to being fair valued at like several $100s. So it's, to me, I'm like fundamentally strong. Technically, it trades like a dog a little bit. Like this sideways action broke the 200, broke the 50 kind of, but it's because people aren't excited by this company. But if you look at strong companies during bad times, aka what you're in now, they're knocking earnings consistently out of the park and being transparent with their investors. It's like, okay, so you're transparent, I can get a discount on the price, and fundamentally you just keep knocking it out of the park. So until that changes, I'm not going to change my tune on Crocs, being like, hey, buying the dip on this company may not be a bad idea. And dollar cost averaging up, dollar cost averaging down, whatever. But like, you obviously have stop losses in place that you don't just like ride this thing to zero. Any company can go to zero. I'm not saying Crocs is. But if you look at it and compare it to other companies, right? Once people are tired of those companies and they find companies like this, it's very interesting to see how the price action goes.
Not to mention, so what I meant was, like, for example, if they just did like a 5-6% rise, like a 21% rise, whatever number you said, for just a forecast. Imagine if they come in and then they're like, whoa, this is even higher than what, that's what I'm saying. They might even pull like an Nvidia kind of thing.
Oh, yeah, the 32%
remember, Crocs did like
one day.
20, right? Like Crocs really did 20% in one day.
Yep.
So
watch it be like a 50% increase. That'd be insane.
It's possible, and that's my point. Is that it's possible, especially on earnings. So yeah. But anyways, guys, I think that will pretty much do it for this video. It's just gonna be a lull kind of week. It really, really is. We're just kind of just sitting here, just waiting for something to happen, earnings as well as FOMC. But yeah, aside from that, there really isn't much of anything. We are going to be live streaming this upcoming week when it comes to what did we say? Goldman Sachs, Morgan Stanley. Yeah, Discover. We're essentially going to live stream Discover. Yeah, that's right. We're gonna be live streaming, I would say, every day. We'll see. But if something changes, obviously, you guys will get the notification of the stream or not. So yeah. Make sure to stay on the channel, guys. Like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. And, of course, make sure to follow us on X. to get all types of news from us. So thank you guys so much for watching. Peace out, and we'll see you all next time.